The dollar problem just got worse, and most people still think this is just another war headline. It is not. This is about what happens when military conflict collides with debt, inflation, energy shock, and a global financial system already stretched too far. Gold and silver are not moving because investors suddenly became emotional. They are moving because the market is starting to understand something dangerous. War does not just destroy cities, it destroys trust. And once trust in the system starts to crack, money runs toward what governments cannot print. What happened is simple on the surface and serious underneath it. A new wave of geopolitical tension has hit a world economy that was already unstable. Governments are spending aggressively, central banks are trapped, oil markets are nervous, shipping lanes are vulnerable, and the reserve currency of the world is being asked to carry even more pressure at the exact moment confidence is becoming harder to maintain. That is why this matters. This is not just a battlefield story, it is a currency story, it is a debt story, and for gold and silver, it is exactly the kind of environment that turns a slow trend into a violent repricing. Most people hear that war is bullish for gold and assume the logic ends there. Fear rises, gold rises, end of story. But that is only the first layer. The bigger issue is what war forces governments and markets to do next. Wars are expensive. They drain budgets. They increase borrowing. They distort energy flows. They push up insurance costs, transport costs, and often commodity costs. They make inflation harder to kill. And that becomes a direct problem for the dollar, because the dollar only looks strong when people believe the US can manage all of these pressures at once. The second that belief weakens, precious metals stop looking like a side trade and start looking like a monetary response. And this is where the real tension begins. Because the dollar is not just another currency, it is the foundation of the modern global system. Trade, debt, reserves, commodities, capital flows, all of it leans on the dollar. That system works when the world believes American debt is safe, American policy is credible, and American financial assets still offer stability. But now look at the backdrop. Debt is enormous. Interest costs are rising. Fiscal deficits are massive. Political dysfunction keeps returning. And now you add war into that mix. Suddenly the dollar has to be strong enough to fund huge obligations, stable enough to calm markets, and trusted enough to remain the default safe haven. That is a heavy burden, maybe too heavy. Gold benefits when trust in paper promises weakens. Silver benefits when that same trust problem meets industrial pressure and monetary demand at the same time. That is why these metals tend to behave differently from most assets during geopolitical escalation. They are not someone else's liability. They do not depend on a central bank speech. They do not need a government bailout. When the system starts looking fragile, gold and silver do not need a marketing campaign. They become relevant automatically. Now here is what most people are missing. War can actually create a paradox for the dollar. In the very short term, crisis can push money into the dollar because traders rush toward liquidity. But the same crisis can also worsen the long-term case against the dollar because it increases the structural damage already building underneath the surface. More spending, more deficits, more supply shocks, more reasons rates stay politically difficult, more reasons foreign governments ask a quiet question they were already beginning to ask. Do we really want all of our protection sitting inside one overburdened currency system? That question matters more than most investors realize. Because the reserve status of the dollar has always depended not just on military power or economic size, but on trust. If foreign central banks, sovereign funds, and global institutions begin to diversify even slightly faster, the effect is bigger than it looks. They do not need to abandon the dollar overnight. They only need to trim exposure around the edges. A little more gold in reserves here, a little less treasury demand there, a few more bilateral trade deals settled outside the dollar. None of these moves look dramatic on their own. Together they form pressure, and pressure is exactly what gold responds to. That is why this moment is more serious than the average headline suggests. Gold is not merely reacting to conflict. It is reacting to a system that has less room for error than it used to. 20 years ago, the US could absorb major shocks with a different balance sheet. Today, the margin for policy mistakes is thinner. Every new crisis lands on top of old, unresolved problems. The market sees that. It may ignore it for weeks or months at a time, but it sees it. And then there is silver, which is where the story becomes even more interesting. Gold is the obvious safe haven. Everyone knows that. Silver is where the market often hesitates, then suddenly wakes up. Because silver sits in two worlds at once. It is a monetary metal, but it is also an industrial metal. That means it can lag at first, look forgotten, and then move with shocking speed once investors realize the inflation problem is not going away and the industrial demand picture is still intact. If gold is the alarm bell, silver is often the accelerant. Think about the setup. If war keeps energy prices elevated, production costs rise. If shipping gets disrupted, supply chains tighten. If governments respond with more spending, deficits worsen. If inflation proves sticky, real rates become harder to manage. And if growth slows while prices stay high, policymakers walk straight into the nightmare they hate most: stagflation. That is the environment where gold stops being an optional hedge and starts becoming portfolio insurance. And silver can go from neglected to chased very quickly, because once monetary demand returns, it hits a much smaller market. This is why the phrase bullish for gold and silver is actually too small for what may be developing. Bullish sounds like a normal market call. This is bigger than that. This is about repricing monetary credibility. Gold rises when the market begins to think central banks are not fully in control. Silver rises when that same realization spreads from institutions into broader capital flows and speculative momentum. One metal leads with authority, the other often follows with violence. Now let's go deeper into the dollar problem itself, because this is the core of the entire story. The U.S. has financed global leadership, domestic spending, crisis interventions, and financial rescues through a system that assumes deep demand for Treasury debt will continue. But that assumption becomes harder to maintain when debt servicing costs rise and deficits remain enormous even outside recessions. Add war risk, and suddenly markets start asking whether future spending will be restrained or expanded. History gives a pretty clear answer. In times of conflict, governments do not get fiscally conservative. They spend, they borrow, and they tell themselves they will deal with the consequences later. Later is where gold lives. Because gold does not care about the speech. It cares about the imbalance. It cares about whether the promises being made today require more printing, more borrowing, more suppression of real rates, or more financial repression tomorrow. This is why gold can rise even when the dollar looks strong in the short run. The market may seek dollars for immediate safety, but it can still buy gold as a vote against the long-term trajectory of the system providing that safety. That is not a contradiction. It is the market separating short-term liquidity from long-term trust. And trust is precisely what wars tend to damage. Not instantly, not in a straight line, but steadily. They expose dependencies. They reveal supply vulnerabilities. They force emergency responses. They make inflation harder to predict. They widen the gap between official messaging and lived economic reality. When that gap gets too wide, hard assets begin to speak louder than policy statements. You can already see the ingredients. Central banks around the world have been buying gold aggressively in recent years for a reason. They are not doing it because they suddenly became nostalgic. They are doing it because gold is neutral. It carries no political loyalty. It is a reserve asset without counterparty risk. In a world of sanctions, fragmented trade, and weaponized finance, that neutrality becomes more valuable. War only sharpens that logic. Every new geopolitical fracture reminds nations that reserve management is no longer just about yield. It is about survivability. That point is critical. The old world assumed efficiency mattered most. Hold the dominant reserve currency. Buy the highest liquidity sovereign debt. Keep the machine running. The new world is slowly shifting toward resilience. Diversify reserves, secure commodities, de-risk strategic exposure. Gold fits that world perfectly. Silver can fit it too, especially once inflation psychology returns and retail capital begins searching for the cheaper monetary metal with more upside torque. Now consider the policy trap. If war-driven inflation pressures rise, central banks are in trouble. If they keep rates high, they increase debt stress and economic weakness. If they cut too soon, they risk reigniting inflation and weakening the currency. That is the trap. And trapped central banks are historically very good for gold. Because gold performs best when policymakers lose the luxury of clean choices. When every option has a cost, confidence erodes. Investors do not need the system to collapse. They only need to believe it is becoming harder to steer. Silver becomes even more compelling in that scenario because it is still widely underestimated. Many investors treat it like gold's volatile cousin and leave it there. But silver is more than that. It is a smaller, thinner market tied to both monetary fear and industrial necessity. That makes it uniquely explosive when the macro environment shifts from ordinary inflation anxiety to deeper monetary concern. It does not have to outperform every day. It only has to catch the market's attention. Once that happens, the move can get aggressive fast. Another thing most people miss is the psychological timing of these moves. Precious metals often climb the wall of disbelief. They do not need universal agreement. In fact, they usually move best when most people are still dismissing them. The market goes through stages. First, gold rises quietly, and people call it noise. Then it keeps rising, and people call it fear. Then silver joins, and people call it speculation. Then the move broadens, and suddenly everyone pretends the logic was obvious all along. By the time the mainstream narrative catches up, the easy part of the move is usually gone. That is why this title matters so much. The dollar problem just got worse. Not maybe, not theoretically, worse. Because war adds strain to a system already struggling with too much debt, too much dependency on low rates, and too much confidence that policymakers can always engineer a soft landing. Maybe they can stabilize the next headline. Maybe they can calm the next market wobble. But can they solve the deeper contradiction? Can they fight inflation, support growth, fund deficits, manage debt service, protect the currency, and absorb geopolitical escalation all at once? That is the real question. Gold is rising because the answer looks less certain than it used to. And if that answer keeps weakening, then the implication is larger than a normal precious metals rally. It means gold is not simply going up because the world feels nervous. It means gold is responding to the possibility that the monetary architecture itself is becoming less trustworthy at the margins. Those margins matter. Great shifts begin there. The same is true for silver, but silver adds another layer because it can stay quiet longer and then catch up with stunning speed. It often punishes impatience before rewarding conviction. That is why silver markets can feel frustrating right before they become dramatic. Small market, thin liquidity, big emotional swings. Then suddenly a macro catalyst aligns with physical tightness and monetary demand, and the move becomes impossible to ignore. Here is the hidden risk for anyone still complacent. If war expands or persists, the inflation impact may not come only through oil. It can spread through freight, insurance, food, metals, manufacturing inputs, and broader risk premia across global trade. That means price pressure can reappear in ways central banks cannot easily neutralize. This is not the clean inflation of stimulus checks and reopening demand. This is more chaotic, more fragmented, harder to model, and markets hate what they cannot model. Gold loves that, because gold does not need a perfect inflation report. It needs uncertainty around policy credibility, currency stability, and real purchasing power. Silver needs that too, but with the added bonus that once momentum arrives, it can attract both macro buyers and speculative money. That combination can create a move that looks irrational only to people who ignored the setup. Now picture how this escalates. More conflict headlines, higher defense spending, more commodity volatility, bigger fiscal strain, more pressure on central banks to choose between recession and inflation. Meanwhile, foreign reserve managers continue diversifying quietly. Retail investors wake up late. Institutions begin hedging earlier. Gold pushes first. Silver starts lagging, then narrowing the gap. The narrative shifts from isolated rally to macro trend. Then the conversation changes completely. It is no longer whether gold and silver should be up. It becomes how far this repricing can go if confidence continues to fade. That is the part the average investor usually misses. Precious metals do not need hyperinflation to perform. They need mistrust, constraint, and policy weakness. They need real rates that stop offering meaningful comfort. They need debt burdens that make aggressive tightening politically painful. They need global fractures that make reserve neutrality valuable again. In other words, they need exactly the kind of world that prolonged conflict can help create. And once the market starts sensing that, every dip in gold begins to look less like a reversal and more like a transfer of metal from weak hands to strong hands. The same with silver, except silver's transfers are often more emotional because the metal is more volatile and less understood. That volatility scares people out before the bigger move arrives. It always has. So what are most people missing right now? They are missing that war is not just a fear trade. It is a monetary accelerant. It pushes on deficits. It presses on inflation. It complicates rate policy. It undermines confidence in long-duration paper promises. It reminds central banks and governments that hard assets still matter. And it exposes the dollar to a problem far more serious than a bad headline. The problem is overuse. The world keeps asking more from the dollar at the exact moment the structural foundations under it are becoming more fragile. That does not mean the dollar disappears. It means the cost of maintaining faith in it rises. Gold notices that first. Silver notices it next. And when the broader market finally notices it, the move can already be well underway. This is why the smart money watches behavior, not just headlines. Are central banks buying gold? Are fiscal deficits shrinking or expanding? Are real yields truly stable or just temporarily elevated? Are commodities calming down or staying stubborn? Are foreign governments reducing vulnerability to the dollar system in small ways that add up? These are the signals that matter. And right now, too many of them point in the same direction. Which brings us to the final takeaway. The bullish case for gold and silver is not built on one missile strike, one speech, one oil spike, or one scary week in markets. It is built on accumulation of pressure. The kind of pressure that starts invisible, then becomes obvious all at once. War adds to that pressure. Debt adds to that pressure. Inflation adds to that pressure. Policy limits add to that pressure. And eventually the market stops treating precious metals like an old story and starts treating them like a live answer to a modern problem. That is the setup now. The dollar problem just got worse because the world became more dangerous at the worst possible time for an already strained financial system. Gold is responding because trust is getting more expensive. Silver is responding because once monetary demand returns in size, its market is simply too small to absorb the wave quietly. That is why this matters. That is why this is bigger than a normal safe haven bounce. And that is why the people still calling this a temporary fear trade may be the same people chasing the move after the market has already repriced the truth. If this trend continues, the next phase will not be about whether gold and silver deserve to be higher. It will be about how quickly the market is forced to accept that paper confidence is weakening faster than policymakers can repair it. And when that realization spreads, the move in precious metals may stop looking like a rally and start looking like a warning. So watch the dollar, watch oil, watch yields, watch central banks, but above all, watch the message the metals are sending, because they are telling you something simple, something uncomfortable, and something the market may be far too slow to admit. War is not only reshaping geopolitics, it is exposing the cracks in the monetary system. And when those cracks widen, gold and silver do not just benefit, they become the verdict.